Hello everyone. In this video, I am going to talk about the fundamentals of technical analysis. This is the glimpse of the contents that I will be covering today. I actually know that your time is more valuable. So, let's get started without any further ado.
First we have to start with the theory, and we're going to go through the first section fairly quickly, but the idea is simply that we're trying to buy something to sell it at a higher price, or we're trying to short to cover later at a lower price, and everybody's got that same basic objective. So the idea is simply to buy high and sell low, but actually, what we're doing as investors is we're using information. We all have access to the exact same information. If we look at a company's financial statement, there's about 150 lines of information on it. That's all there really is. We're looking at charts. We're looking at the same information as everybody else in the world who has that chart up. So somehow, we need an information edge, and the edge can be small provided that we're capitalizing on consistently. So, although we only have about 150 pieces of data in financial systems, one study looked at combining all of them in different ways, so we take the growth rate of the various indicators on the balance sheet. We compare it to each other with all the possible ratios. There's about 2.1 million different signals, and it's possible to data mine that in a couple of hours, and when they data mine it, what they find is the amount of money a company spends on advertising is among the most productive indicators to look at, and that actually makes some sense. Advertising might be more useful than sales or even earnings, because advertising expresses the management's confidence. If the company thinks they're going to do well in the future, they'll commit money to advertising rather than just trying to hemorrhage cash. A Tesla doesn't really do any advertising because first of all they don't need to, but they don't have the cash flow to. So what they find is dollars spent on advertising and then cash flow from operations. Growth in cash flow from operations tend to be the most useful of those 2.1 million unique signals. Some investors will go a little bit beyond just the financial statements, and talking to management is, of course, legal, but management isn't going to tell you anything special in the usual world. Management is covered by Regulation FD, fair disclosure. They can only tell everybody information at the same time. So if you call them, you're not going to be first, you're just going to get typical information they give everyone else. Some hedge funds in particular are analyzing credit card data and satellite images to try to figure out where customers are. And if you take the satellite image, you can count the number of cars at various times of the day, and then you can assume that the cars represent customers, and you can spot the amount of information and sales being generated by the number of cars there. This is a brand new idea. It's actually a very, very old idea. Back in the 1800s, Charles Dow got the idea of counting rail cars. So railroad cars were the movers of economic stuff in the 1800s. So by watching the railroad traffic, Dow realized he could get insights into the economy, and Dow also created the Dow Jones Industrial Average then. He first created the Dow Jones Transportation Average because his focus was on railroads, and then he moved on to the industrials because he realized the railroads were moving stuff to industrial companies at the time. So there is really no idea. Satellite imagery sounds so important, but we can still get information by analyzing railroad traffic, and railcar loadings is an economic indicator. Warren Buffett has said that if he could only have one indicator, what he called his desert island indicator, it would be railcar loadings, because that tells him about the economic flow of the future. If raw materials are moving to factories, you're going to see railcar loadings increase. That kind of economic data works very well with the technical indicators we're going to be talking about, because it's the changes in the data that have more information than the data itself. This is an example of that, the parking lot data, and the trend here was showing a decrease in car counts. So you're going to be looking at, you're going to have to look at the trends. It's retail data, and this is a great example of how a chart has these huge spikes in it. So what we often see is seasonality in the data. We'll talk about how to address these anomalies in the data, but this is a great example of looking at the big picture rather than the individual data points. This is actually a big jump and then a big decline, but it's very clearly related to just some type of sale activity at the store. what we see is there is a big drop-off after the holiday season. There is a big increase in spring as Walmart just brings shoppers into the store through different strategies. Looking at the parking lot data, it's highly correlated with increases or decreasing in same-store sales, and that makes sense. If shoppers are driving to the store more, we would expect to see sales at that store increase. So what we're looking for is leading data, and hedge funds are using its parking lot data, but we should be able to spot the same factors, because if the hedge funds are using the data, they're buying or selling based on it. Technical analysis is basically just looking for who's buying or selling. We're looking for unusual activity, and if you just go in and you buy 10 shares of something, the truth is you're not going to move the stock. If a hedge fund goes in and buys $1 billion worth of the stock, they could be moving it, and if a hedge fund is buying $1 billion worth of stock, there's somebody at the exchange who noticed that, they may buy it. It's all going to be a cascading series of information. So we could use ultra-specialized information like parking lot data, or we could step back and use the technical analysis tools, which if we use them consistently can spot this kind of activity in the stock market. So what I want to highlight is something that maybe isn't always grasped by especially fundamental investors, and that's the difference between a stock and a company. So we can have a very good company and a very bad stock, and an example of the difference between company and the stock could be Tesla. Tesla makes electric cars, but they don't make money. So if they don't make money, I might consider them to be a bad company. A lot of people think Elon Musk is a genius. He's going to make money 10 years from now. If your time frame is 10 years, that works, but most of our time frames are shorter than 10 years, would measure on a quarterly basis, even a daily basis. So we want to distinguish between the company and the stock, and that can be difficult to do, but technical analysis focuses solely on the stock and completely ignores the company behind it. That means this is applicable to any data series. So we could analyze economic data with technical. We can analyze any bond market, foreign exchange. The tools that we're going to talk about, the examples are mainly stock driven, but the principles apply to any freely traded market or any data series that looks like price data. I know we have MBA students in here, and this is basically what the whole puzzle of the stock market is. We're trying to develop some kind of a discounted cash flow model to tell us what the total value of the company should be. We get its enterprise value, and it's all just based on the future cash flows, which we discount back. Seems very scientific, but that's going to tell us the value of the company, and it has nothing to do with the stock in reality. The stock price is going to vary dramatically. Now this is an example of going back to 1870s of the price to earnings ratio. So we have the fundamental data here. Remember, stock prices are supposedly dictated by the future value of the cash flows. They change slowly over time. Cash flow, this is for the economy as a whole. This is for the US stock market. Cash flow grows or decreases just a few % a year, and it does nothing to explain these wild swings that we see here, and supposedly we can factor in interest rates, and that should help us understand the swings. This is Shiller's cyclically adjusted P/E ratio, so this accounts for interest rates. So based upon the fundamental cash flow models, based upon everything in the MBA programs, there's nothing to explain why the P/E ratio goes from 5 to 45. The reality is that's where technical analysis comes in. So a stock's price, whether and however we think about it, really comes down to two components. There is the fair value of the stock, and there's a factor for sentiment, and we can calculate the fair value in many different ways. Doesn't matter, the stock price is never equal to that fundamental value. There's this sentiment factor, and this is just a formula. It's unsolvable, I just made it up to illustrate the point. If you can figure out what this value is, you have broken the key to the stock market. An awful lot of people pretend to know what the value of the stock is. We don't have to pretend to know, we know what the price is. We can look that up on a quote screen at any time, they never equal each other. The reason they don't is because of sentiment. If I'm bullish on the stock, I'm going to pay more than its current value because I expect that current value to increase in time. If I'm bearish, I'm not going to be willing to pay that fair value. I'm going to try to buy it under its book value for example and then try to buy it at a discount to its cash flows because I don't believe the company can go for the long run, and a great example of sentiment is that stock in Tesla where the company doesn't make money. They don't make cars that really meet the need of most people. I live way out in the middle of the country. We don't have Teslas out there because the range on Tesla is only 200 miles and we could be 200 miles between electric plug-ins. So it doesn't meet the needs of people who don't live exactly on the east coast or west coast of the country. The people who live on the east coast and west coast of the country in the US are the ones who drive the sentiment factor, and we see this in politics also, where sentiment deviates violently based on regions, and this applies in other countries as well, where we have huge dichotomy between political parties, between social classes. This is basically impossible to understand. Fortunately, we don't need to understand it. We need to know simply, is it greater than 1 or less than 1? If it's greater than 1, sentiment is greater than 1, it's bullish. If it's less than 1, it's bearish, and we should expect the P/E ratio to be higher than average when the mood of the country is bullish. We are seeing right now a shift in a lot of countries. In Europe we are seeing the rise of the European election showing the rise of nationalism. In the US we are seeing worries about trade wars. We are seeing a shift in sentiment lower, and as we see a shift in sentiment towards a lower value, we're going to see stock prices decline. We are going to see that in fundamental metrics. We're going to see it in every metric there is. So market prices will fluctuate around that intrinsic value, and it comes down to optimism and pessimism, and that's all technicians are trying to understand is the mood of the market pessimistic or optimistic? And then is the mood of this individual currency or foreign exchange or stock overly optimistic or overly pessimistic? The money is going to be made at the extremes. If we have a big company that's just floating along a currency that nobody cares about, there's no money to be made. We want extreme optimism or extreme pessimism because from a technical perspective the money is in the outliers. We know that in a rough sense returns are going to be normally distributed. There's no money if the peak are curve, the money's in the extremes. Fortunately, we can make money now on either side. So value investors are always going to be focused here. We're going to focus here for the next few days on just that sentiment factor. That means we can't ignore value, and this can be kind of scary for some investors at first. If you're a skilled and basically value analysis P/E ratio of 100, 200 seems like the stock is not a buy. If you're a technical analyst, you're not really worried about that value. You're looking at the price action. You're ignoring the P/E ratio. You're going to buy when you get a signal, and you're going to sell when you get a signal. The important part being you're going to have a strategy for when to sell, ideally before you even buy, rather than trying to react emotionally as the trade unfolds.